Welcome back to Dukascopy TV. Joining me to discuss whether stimulus brought in by central banks really works is Michel Girardin from UBP. Thanks for joining me today, Michel. So, the US and the central banks have recently brought in monetary stimulus. How does it work and why do they do this?
Well, many people think that when monetary policy is eased by central banks, when central banks provide more liquidity to the market, that they took some kind of helicopter and then dropped the money over the cities and everyone is waiting for all this money to drop from the sky. Well, it doesn't happen that way, unfortunately. Basically, there are various tools, and it's very interesting that at this juncture, both the central bank in the US, in Europe, and even in Switzerland are all conducting accommodative monetary policies, providing more liquidity, but by different methods and for different goals. But let's say the common reason for all these central banks to provide more liquidity to the market is some fear that the economy goes back into a recession. So that's the common cause. In the US, the Federal Reserve just provided a further program for so-called QE, quantitative easing 3. When interest rates are brought to zero, that's the orthodox way of providing more liquidity to the market. When they are zero, you can no longer ease monetary policy. So the way to do it is to increase the quantity of liquidity for the economy. And the way to do that is you buy government bonds, or you buy, and this is what the Federal Reserve just decided to do last Thursday, you buy other type of securities. In this case, they buy mortgage-backed securities. The idea for the Federal Reserve is to help the housing market, therefore in the US, therefore provide some kind of wealth effect for the people that live in the US, the consumers, and this will be positive for the economy and positive possibly also for the Democrats to re-elect Obama. That's more or less the idea in the US.
Do you think stimulus works? Do you think these strategies implemented by central banks will work?
Well, as we say, the central banks can bring the donkey to the fountain. That's the way we say it in French. In English, you say you can lead the horse to the river, but you cannot force it to drink. Central banks now are easing their monetary policy. The idea is that this liquidity, which is then taken by the banks, the commercial banks, is then given to the real economy, to the consumer, to the entrepreneurs for them to consume and them to invest. But nobody forces them. So if the banks don't want to lend the money, don't want to provide more credit to the real economy, well, we are in a so-called liquidity trap, as Japan has been in this situation for the last 15 years. And here we have a problem because in Europe, the banks are being asked to raise capital. The thing is, they look at the balance sheet, we look at the balance sheet of the banks, we look at the capital and we say there's not enough capital. So these tier 1 ratios for capital need to be increased. And the way to increase that is to, for most of the banks, is to reduce the size of the balance sheets, hence to provide less credit. So here we are in a bit of a catch-22 situation whereby the central bank is providing more liquidity, but this liquidity stays at the central bank, is not used by the banks to provide more liquidity to the real economy.
So the Swiss National Bank it's easing its monetary policy quite aggressively. Why do you think they're doing this?
There are fears at the Swiss National Bank that this overvalued currency could derail the Swiss economy and provoke a sharp slowdown of the economy through the export channel, which is key to the Swiss economy. So the Swiss National Bank first eased interest rates to zero, basically, but they instead decided to adopt a policy whereby they would set a ceiling to 120 against the euro, and they would intervene whenever the Swiss franc was nearing that ceiling, and they would basically sell all the Swiss franc, unlimited amounts of Swiss francs to investors, speculators that want to bet against the euro for the Swiss franc. but they've managed to keep what they promised, i.e. that the Swiss franc does not go above 120 versus the euro. And since Draghi came with this message that broke the neck of all the speculators that were betting against the euro, that we will do everything we can to preserve the euro, it worked. The euro has risen against the dollar and is also now rising a bit against the Swiss franc. So it's providing some relief to the Swiss central bank.
Do you think central banks should be behaving differently in light of this economic or financial crisis we're undergoing?
So in light of this asymmetrical thing, what I believe is that central banks should be more active to prevent a crisis from happening, to prevent excessive debt, and be there and look at financial markets and look at housing prices, and when they spot a bubble, they start raising interest rate. They don't just sit pat, let the bubble burst, and then come and provide all the liquidity they can. It's earlier, before the crisis, that they need to act, to preemptively act, not after the bubble has burst, to try to reflate the economy. It's far easier to stop the excesses before they happen than once they've happened and it's burst to try to kickstart the economy again.
Well, thank you so much for your great insights, and thank you so much for joining me today. Well, that's all we've got time for right now, but stay tuned to Dukascopy TV for more updates and interviews. For now though, goodbye.